Hello everyone, namaskar to all of you. Today we'll be talking about one more interesting topic. It is interesting because of the fact that this is a combination of two concepts. One is the mutual fund and other is the risk associated with debt instruments, which we have already been talking about in some of our videos. In the last video, we talked about some of the risks associated with debt instruments, and one among them was default risk. So there is not much one can do if the bond or the bond issuer gets bankrupt. But in the mutual fund, especially after 2018, when the infrastructure leasing and financial services limited was not able to make the interest and principal payment. At the time, SEBI came out with regulation that the mutual fund manager can make a segregated portfolio for the less liquid or illiquid or risky assets. Let me explain this with the help of an example. Suppose you went to the supermarket and you bought, say 100 pieces of apple. All the apples were looking good and they were absolutely fine when you bought them. But when you kept all the apples in your basket, when you reach home, then you saw that some of the apples are not good. So what do you do in that case? You segregate those apples into a different basket. And this is what the segregated portfolio or side pocketing concept in mutual fund is all about. Suppose a mutual fund has invested in certain debt instruments like commercial paper or other debt instruments. It may happen that some of the assets, some of the debt instruments may become illiquid because of downgrading or because of default. At the time, some intelligent investors will redeem all the money, and but there are a lot of investors who may not be that aware and who don't keep themselves up to date about all these market happenings. They may get trapped, and for them it will be a difficult situation, as they will not be able to withdraw. I mean, in mutual fund sense, it is not a redemption. They will not be able to redeem their invested money. This will put them at a lot of risk. So, in order to overcome, in order to protect the interest of such investors, this segregated portfolio concept has been introduced in, I think, towards the end of 2018. During this process, the fund manager will have to make two portfolios, one containing the bad assets or illiquid assets, the other one will contain the good or safe investment. And at that time, no redemption or new investment is allowed in that segregated portfolio. This way, the risk associated in the mutual fund, especially the debt mutual fund, whenever there is a default in the commercial papers or in instruments, debt instruments they have invested, can be overcome. This is all we have in today's video. Please keep inspiring me, and I'll come up with new interesting videos to discuss with you. Thank you all. Namaskar.